The Dow Jones Industrial Average closed above 50,000 for the first time on Friday. This milestone harks back to the era of 1900, when railroads and the Industrial Revolution reshaped America's financial landscape. Today, artificial intelligence serves a similar role as the new growth engine, fueling market euphoria while introducing risks of excessive valuations and industry disruption. It perfectly echoes Dow founder Charles Dow's core belief. Every boom carries the potential for a severe bust. The Dow's steady climb encapsulates long-term U.S. stock growth. From its lows around 6,600 during the 2007-09 Great Recession, to a post-pandemic doubling, and now to 50,000, it's backed by the relative resilience of the U.S. economy and Silicon Valley's enduring pull on global capital. As a price-weighted index of just 30 stocks, the Dow's 13% gain in 2025, while trailing the S&P 500's 16% and the Nasdaq's 20%, accurately captured this rally's core driver, artificial intelligence and tech infrastructure. Tech giants like Goldman Sachs, Microsoft, and NVIDIA were primary drivers. Traditional industrials like Caterpillar and IBM also saw their valuations reassessed due to power demands from AI data centers and their own AI business plans. While this AI-driven advance rivals the scale of the 1990s dot-com bubble, it's fundamentally different. Today's industry leaders have solid profit foundations, not just speculative hype. Yet, risks are quietly building beneath the surface of prosperity, and the very AI frenzy fueling the rally may be its biggest vulnerability. On one hand, valuation anxiety over AI giants is intensifying. Investors are questioning whether massive corporate AI investments will translate into real returns, even fearing AI products could disrupt existing industries. Recent market fears about AI upending the software sector directly triggered sell-offs in software and chip stocks, a primary cause of recent short-term volatility. On the other hand, signs of cooling speculative sentiment are emerging. Investor enthusiasm for profitless tech companies has notably diminished. Now, a single company's earnings report or a piece of AI infrastructure news can trigger sharp swings across an entire sector. AI has become the stock market's sentiment indicator, but its prominence and the market's hypersensitivity to it also render it a potential risk trigger. Internal divergence among Dow components sounds another alarm for the market. While tech and industrial stocks led gains, consumer and brick-and-mortar retail-related names like Nike, Procter & Gamble, and Home Depot all declined over the past year. A core signal of Dow theory, the linkage between the Dow Industrials and the Dow Transportation Average, also showed a significant divergence in 2024. Weighed down by Fed rate hikes and the AI race siphoning market capital, the Dow Transports lagged the industrials for an extended period, a clear sign of pressure on non-tech sectors. Although the transports have surged 25% in the last 3 months, far outpacing the industrial's 6.8% gain, a move interpreted as a signal of real economic recovery, the sustainability of this short-term rebound remains uncertain. In this AI-driven market boom, investor psychology is no different from when the Dow was created in 1900. Charles Dow noted that investors perpetually cycle between excessive optimism and pessimism, the very root of stock market fluctuations. Today's U.S. market remains subject to this rule of human nature. Veteran trader Ted Weisberg, who lived through Black Monday 1987, the subprime crisis, and other market doomsdays, knows well that trees don't grow to the sky, yet no one can perfectly time the exit. Investor Neil Hennessy, while bullish on the market's current liquidity and corporate earnings fundamentals, also admits that the valuation bubbles and sentiment swings lurking behind the prosperity remain a sword of Damocles over the market. From the railroad and industrial revolution of 1900 to today's AI wave, the engines of U.S. stock growth have changed, and the Dow has climbed from double digits to the historic 50,000-point peak. Yet Charles Dow's warning remains as relevant as ever. Today's AI frenzy, much like the railroad revolution of its day, is continuously reshaping industries and the financial landscape, pushing stocks to new records. But just as then, no one knows for sure when this AI-driven boom will reach an inflection point, or whether sectors riding the AI wave to soaring valuations might suddenly face contraction and devaluation. Dow 50,000 is a major milestone for U.S. stocks in the AI era, but it is by no means the finish line. While enjoying AI's dividends and embracing the prosperity, the market has long been wary of the multiple risks lurking beneath. The potential bursting of AI sector valuation bubbles, the disruptive impact of AI technology on traditional industries, and the developmental imbalance between the real economy and the tech sector. An escalation of any one of these risks could be the last straw. This very vigilance is the sobriety the U.S. stock market must maintain amidst its euphoria.